right. All right, everyone. Thank you for joining us today for our presentation on managing student loan debt. So today our guest speaker will be Jason Anderson. And so my name is Tia Sandoval, and I work in the Office of Student Financial Accounting at KUMC. And I'm joined by our director, Scott Sponholtz, as well. And so Jason is currently a CPA, a CFP, and a lecturer and academic program associate in the KU School of Business. So he has a lot of great experience and expertise in this area, and we look forward to having him give this presentation to us. If you have any questions or anything, you can go ahead and drop them in the chat, but he is planning on, at the end, answering any additional questions that students have. So at this time, I will pass it over to Jason.
Thanks so much. Yeah, and there's a couple other things I'd add on to that. Not that I need a longer resume. In academia, we tend to have ridiculously long CVs, but there are a couple others. I'm a doctoral student in the personal financial planning program at K-State, our rival institution, but it's a really good program in personal financial planning. And I don't have a disclosure for this second thing, but you should know, compliance likes me to say, that I wear my hat at KU, which is what I'm doing for this presentation. I am in my role as a professor in the School of Business, but I also run on the side a company called GradMetrics, which counsels all sorts of clients across all sorts of professions and student loans. And so I do have expertise actually working directly with clients in this area as well, which hopefully will inform my presentation today. But it's good to see everybody on the call. We're going to talk specifically about student loans when it comes to the medical professions. And there are quite a bit of opportunities with medical professions because you all are in such high demand that there are some great opportunities when it comes to student loans. Okay, so what are we going to cover? We're going to generally cover student loans. We're also going to talk about student loan strategies and then additional resources. And Scott, remind me how much time I
have. We have an hour, but you know.
Okay, great. Good. Well, hey, we got tons of time for questions and content. I just wanted to make sure actually 30 minutes would probably not be enough. So I'm glad we have some extra time. All right, so let's talk student loans in general. When we talk just average student loan payments when you're getting out of school, of course, you don't have to answer. This is kind of a rhetorical back and forth in a presentation like this, but what do you think that average student loan payment is? And this is average student across the United States, which really has some caveats when we talk about the audience that I'm talking to right now. Many of you all will come out with significantly more in a monthly payment, but it's $393 currently. Like I said, if you're a medical student on this call, throw this number out the window, okay? Like this would be a panacea. You're gonna be probably paying significantly more than $393. Some of you all might get out with less if you're at the undergraduate level, but debt is a problem. Student loan debt right now is a significant problem. It's right now sitting at 1.73 trillion. And actually, if we look at all credit card debt in the United States, what do you think that is? It hovers around like $1 trillion. So if we look at student loan debt compared to credit card debt in the United States, significantly more out there. And actually, when I started doing college and student loan planning, this number was like at 1.2. And so we're looking probably in the last like 4 to 5 years, this has ballooned almost to 2 trillion now, which is kind of crazy when we look at how much this is increasing over time. Delinquency rates are high. And that's actually, speaking of which, if you're like a medical professional or someone else looking at maybe refinancing at some point, and we'll talk about that, there are lots of financial institutions that don't refinance in this space. Why? Because if they're a conservative financial institution, they're probably not going to get in the student loan game. There's a decent amount of default in this space when we compare to other types of debt. Federal student loan borrowers, 4.9 million. By the way, we will focus on federal student loans in this presentation. Many of you all will, the lion's share of your debt will likely be in that category. In average student loan debt, we're looking at 37,000. Again, some of you on this call would not surprise me if you get off this, get out of your education at 300, 350. it can be a lot, depending on how far you're going in graduate school or in the medical profession in general. When we look at it from a geographical perspective by state, Kansas, we're actually a nicer bluer color that I'd like to see. But you can see that if you're on the coast or even our neighboring state, Missouri, you're going to come out with more on average. So there are a number of factors that will play into this, what type of school you're at. Of course, I'm in a captive audience here in the KU sphere. But depending on where you go to med school or where you get your education, where it's at on the coast. And of course, a lot of this is also your cost of living. So some of you all might go off to residency, for instance. You might be in New York City. Your debt is going to be significantly more because of the cost of living than you would be if you took a residency in KCK, for instance, which is on the top 10 affordable list, by the way. So kudos to you all being in a place where the debt will likely come out less because of that, but it can be a lot more. So I told you I'm a doc student at K-State, so I got to bring them in, right, and razz a little bit. Although I will tell you the undergraduate stats at KU are really not that much different. So if we look at, and many of you all are starting at the undergraduate level, you're maybe going beyond this, but let's just start with undergrad. The reason why we see so much student loan debt out there is because costs have ballooned. And I have a whole other presentation about why that's the case. We won't cover that information here, but higher ed is significantly more expensive than it was a decade, 2 or 3 ago. Those days of your parents going to school, working it off over the summer are long gone. So if we look at a full cost of attendance at a place like K-State, and this is living on campus, room and board, personal expenses, transportation expenses, fees, everything per year, what do you think that is? Again, these questions are rhetorical, but you can think in your own mind and give yourself a good guess. So that number is $27,185. And of course, we have to add inflation over time. Places like KU, K-State haven't been increasing tuition recently because of COVID, but generally they would. So if we put in a 5-year increase over 4 years, and by the way, many students don't graduate in 4 years. Many schools don't even keep a 4-year timeline anymore because it's 5 plus. We're looking at $117,170. So just getting out of undergrad, we're not even talking about maybe those of you that went off to med school or grad school or researching or whatever. You're looking at a significant amount of debt out of the gate just to get the undergraduate degree. And this is at a state school. It's supposed to be affordable, which is kind of crazy when we think about it. So when we're talking about student loans, they really come in 2 main categories. And again, we're going to focus on the first category, which is federal student loans. These are funded by the government, and their kind of method of how they're distributed and who is giving those loans and how it's actually handed out to students, that's changed over time, but essentially funded by the federal government. That's how we can think of these. And then we have private student loans. So some of you all might be going out to a bank or credit union, another financial institution, a Sallie Mae, whatever that looks like. Those are private student loans. Those tend to have a lot less perks. So many of the perks that we're going to talk about today in terms of income-based repayment plans, loan forgiveness opportunities, those simply in many respects don't exist in the private space. There could be some programs, especially like state programs and loan repayment programs, employer benefit programs that might cover this category, but a lot of the main kind of overarching benefits we are reserved for the federal category. So when we look at those loan types, you have the subsidized, you have the unsubsidized, which the difference here is whether the government is paying for the interest while you're in school. But surprise, during COVID, they're pretty much paying for all of it. So that's a good thing for the majority of the categories in the federal student loan class. But in a normal world, a normal environment, your interest would be accruing on unsubsidized loans. So like I have unsubsidized loans for my doctoral degree. Once the COVID assistance expires, like I will start accruing daily interest on those. The subsidized loans, not so much. So the government is paying for interest while you're in school. Then we have the plus loans, which is a different category. Some of you all, especially as you get to graduate school, might be offered a mixture of maybe the unsub loan category, but you're also probably offered the plus loan category. And part of that is because all the aid that you're given and the full cost of attendance at a school, if there's a difference between that, you might be offered really a plus loan, which I would call like a gap loan, could be offered to parents, could be offered to certainly your graduate student as well. And so plus loans are a different animal. And especially when we get out of undergrad, the government doesn't care as much per se about us getting educated beyond that. It's not necessarily subsidized. It's not necessarily lower cost. And so we tend to see higher fees and higher interest rates in this category. So keep that in mind, and we'll talk about that here in a second. Oh, speaking of, here we go. So here are those numbers. And by the way, these numbers for federal student loans change every summer. But currently for direct plus loans, for instance, we're at 6.2%, direct unsubsidized 5.28, and then we're at 3.73 for undergraduate borrowers. And I will tell you, these are not at historic lows anymore, but they are significantly low. And I would say, especially for the undergraduate borrowers, guess what? You probably don't have income, you probably don't have assets, and you're not having to go through a credit check or get a cosigner. And so that 33,000, 27, 33,000 that you're being offered in loans at the undergraduate level is good debt in many respects compared to what you might be offered in the private space. One other thing I would say here is keep an eye on the fees. So when we're at the undergraduate level and some of these other categories, we have lower fees, like in the 1%. But when you get up to the plus loans, you're going to have more in fees. And so the 6.28%, we look at an actual interest rate, is going to be higher. So keep that in mind. There are fee differences in these categories. Okay, so many of you all are like, Jason, great, I've already got the debt, like move on, right? I've done my loan entrance counseling, I've signed my MOU, let's move on to the strategy. So that's where we're headed next. So the first strategy, I mean, when we look at a 30,000 foot view, is when it comes to federal student loans, we have different repayment plans. And we know statistically that most people do nothing. And if you do nothing, you're going to end up in the standard plan. So when you're in the standard plan, what does that mean? Well, it's the default plan. So most people are there, they get slated because they don't do anything. And they pay off in a 10-year cycle. So if you're in the standard plan, you start making payments, you'll have it paid off in 10 years, which is much like a car payment or a mortgage. You're looking at 10 years and you'll get paid off. But as you might imagine, when we look at that 117,000 number, or maybe even for those of you that are med students, like really the ability for you to do that is limited in many cases. Depending on your income, when you get out, you just may not be able to do the 10-year standard plan, or it may not be prudent, like you might be going for something like public service loan forgiveness. So there are other plans. And if we look at this category of standard plans first, we have the graduated repayment plan, which this is where you pay less at the beginning of your term and more as the loan ages. So the idea is that your income is going to increase over time. You'll be able to afford bigger payments. But crucially, this is at least under original public service loan forgiveness, not a qualifying plan for public service loan forgiveness. So keep that in mind. We also have extended, so we can extend the term, so we can go beyond 10 years into something larger than that. And again, not a qualifying plan for public service loan forgiveness. But as you might imagine, as you extend your term, your payment goes down. So again, these are kind of at least original iterations of how can I afford my payments and coming up with some creative solutions there. But what we see is most people that are going into repayment plans are not opting for those last two, okay? They're opting for income-driven repayment plans. And there are a number of categories here, but really the ones that we look at are these first ones. So we have pay as you earn and revise pay as you earn. These are qualifying plans for public service loan forgiveness. We're going to talk about some of the particulars as we go along. You also have IBR, old and new. You have income contingent, ICR, and then very rarely you have something called ISR. So I would just disregard that. Really what we're going to focus on are like pay as you earn, revise pay as you earn, IBR. That's generally what we're going to be speaking about. And what's the general 30,000 foot view of what these are? Well, you pay a percentage of your income. So there's a calculation here like federal poverty line and percentage, and there's lots of nuances. I have an entire table that puts all this into perspective, but you're going to pay about 10 to 20% of your discretionary income when that payment is calculated. And then you also have to certify your income every year. So you can't just say, hey, my income's 20,000 and that's it. You have to recertify and tell the government, hey, I made more, I made less, and then they recalculate your payment based on that. By the way, kind of obvious tip number one, recertify. I've worked with clients that didn't, and guess what? The servicer is not just going to let you plod along in the same plan and not turn in your paperwork. They will default you to a revised plan, which puts you way back to like basically a standard plan. And so do this paperwork. When your servicer tells you to do it, you should do it, or you're going to suffer the consequences. And by the way, if you do get put in one of those alternative plans, you still have to go back and recertify. You're not going to get around that to get back into your normal plan. Okay, so income-driven repayment plans tend to be a better option for people who can't afford those payments when they get out. It's also one of the ways that we can kind of strategize around repaying our loans, because if you're going to get forgiveness, the idea is that you want to pay as little as possible until you get to that forgiveness. That's maximizing your value from that forgiveness program. And so many people that are trying to maximize that value on their way to a forgiveness program are going to opt for an income-driven repayment plan. Okay, so now we get to talk about forgiveness opportunities, which tend to be great and lucrative for folks like you that are on this call, because trust me, if I was giving this presentation to English majors, not many programs out there that will help you get forgiveness. Of course, you might be able to slot into public service loan forgiveness or teacher loan forgiveness, I guess, if you were teaching. But for medical professions, there tend to be a lot of programs out there, and we're going to talk about those. So public service loan forgiveness is the main one. And a lot of people out there talk about, 10-year forgiveness, which is great. A little bit of a misnomer though. What it really is it's forgiveness after 120 qualifying payments. Now, of course, if we divide that by 12 months in the year, you'll see that's 10 years. But it's, you could pay this non-consecutively. Like maybe you went and go worked in the corporate sector for a little bit, came back to a nonprofit role. You certainly could continue making those 120 qualifying payments. So that's key. You need 120 qualifying payments. You need a qualifying repayment plan. We've already talked about that for a second. You have to be working full-time for that employer, however that employer defines full-time. And then you have to work for a qualifying employer, as you might imagine. So this is for government workers, military, nonprofit. There's even another category outside of that that you might fall under. If you're engaging in kind of a public service type profession. But this is what we need, at least under the original program. Now, there have been iterations. Maybe some of you are on this call because you've heard of like the waiver program, which is expiring towards the end of this year. But it's essentially kind of waived all those requirements temporarily, where really all right now that you need is the right loan type, which is direct loans, and you need to be full-time employed for a right employer. But really a lot of these other requirements have gone out the window temporarily. There's another program too that you might see your servicer talk about, which is temporary public service loan forgiveness. This was meant to catch people who were in the wrong repayment plan. So if you got denied for public service loan forgiveness, you could qualify under this revised program. What we saw though is it still had a high reject rate. Okay, so didn't really solve the problem per se. But the waiver program is a huge step forward in terms of helping people out. And none of you on this call are going to worry about this, but for instance, like if you qualify under the waiver program and like they backdate all this stuff, like you could get refunds under this plan, you could get immediate forgiveness, like they're going to calculate this on the back end, you basically don't have to do anything. Like it's an amazing program is what I'm trying to say, but waiver program temporarily. We also see other forgiveness opportunities, which teacher loan forgiveness, I put it here. It's not probably not going to be for many of you all, but might be. There's also borrower's defense, which many of you, you're not going to qualify because you're at a reputable institution. But if you have any friends that maybe got scammed by a for-profit school, they could potentially get forgiveness under some of those programs. There's bankruptcy, which is really rare. There's death and disability discharges under certain scenarios. And then there are state loan forgiveness opportunities. We're going to continue to talk about those as we go through. Student, we already talked briefly about this, but there are relief measures because of COVID-19. So you've probably noticed that through May 31st, 2022, you're not accruing interest right now. You're not having to make payments. And what's really cool about this program too is as long as you're kind of in the state of actually making, where you would be making payments, you're not in a grace period, for instance. These payments are qualifying right now for public service loan forgiveness. They're also qualifying for what we call long-term loan forgiveness. So one of the ways that you can get forgiveness, and this is no panacea, but in the income-driven repayment plans, which tend to be 10 or 20 or 25 years, so 20 or 25 years, if you get to the end of that term, it'll be forgiven. Your loans will be forgiven. So, and I like to tell people too that are weary of public service loan forgiveness, that think they might get rejected. you do have the safety net of long-term loan forgiveness and an income-driven repayment plan. Your balance will be forgiven after 20 or 25 years. So again, not great, but if you're in one of those plans, you will get eventual forgiveness. And by the way, that's taxable too. Public service loan forgiveness, non-taxable, which is great, one of the other benefits of that program. But if you are in long-term income-driven repayment forgiveness, you will, at least under current law, be taxed on that. We call it the tax bomb in the industry. And then student loan forgiveness right now, which none of you all are going to have to worry about this, but even private student debt right now that's canceled is tax-free right now through 2025, which is pretty incredible.
Could I
Okay.
interject for just a second, Jason?
Yeah, sure, Scott.
For the no interest and no payment, that executive order is through May 1st of this year. Not
Oh,
2023.
sorry. Yeah, I must have typed that wrong. So I appreciate that. Thank you for the correction. Perfect. Well, yeah, I'm glad we got that one cleared up. Don't want to give wrong information. So first is we're going to talk doctors. I know we have a few probably on this call that are interested from that category. So of course, and you can see right here, the AAMC gives us stats on median 4-year cost of attendance, median education debt. And so that debt is going up. And there are significant, I guess, ramifications to this. Now, of course, you're going to have long-term income potential that is higher than average, to say the least, but there are significant costs to becoming a doctor. And so what I would say with this is that means that the solutions for you are even more important. You need to be aware of what your opportunities are, because missteps can cost you a lot of money. For instance, if you don't plan correctly within your residency and you're going for public service loan forgiveness, you could get to the point where like it's not going to be a viable option for you if you wait until you're an attending doctor. So that can be a significant thing to pay attention to. What I will say though, before I even go into any of this stuff, that the AAMC is an incredible resource. And I can tell you, like, I've tried to find an equivalent resource for nurses, which is where we're going next. And there's nothing that compares to the AAMC in terms of the resources and backing that they give you. And so I did include the link here. I'm happy to share the slides, but you need to go to the AAMC and look at their resources. They have software resources for you. They have kind of step-by-step guides through residency. They have incredible webinars that talk about residency in particular. So really, like, if you got off this call and just looked at the AAMC stuff, you would know exactly what to do going forward. And so please don't ignore that resource. They are incredible and have some amazing, even staff members dedicated to this topic area.
One thing I might just add is they have what's called a MedLoan organizer and calculator.
Yep.
So MD students, this is a great resource to get you through residency. That the calculator takes into account that your income will be lower for 3 years or 5 years or more. They have info on kind of the salaries during residency and as an attending. For other students on this call, you can use that as well. But I think there's a nominal cost. I want to say maybe it's $10 or something like that. So that would be an option if others wanted to take advantage of that as well.
Yeah, the veterinarians have something similar with the Veterinary Information Network, and it has a free calculator. But I would just say, I mean, doctors on the call or future doctors on the call, take this as a nice primer and then go use the AAMC resources, okay? Because exactly right. They're all right there for you. They plotted it all out. They put an amazing amount of effort into it. Top-notch resources. So really the opportunity, one of the main opportunities for doctors is the residency piece. And so part of the reason why it's an opportunity, because you're gonna go into residency, you're gonna make less money. And that's just the way it is. But the good thing is since you're making less money, there are some strategies you can employ, especially in that period of your education, that can be really lucrative and get you on the right path, especially if you're wanting to go for public service loan forgiveness. So you can get mandatory forbearance. If that makes sense for your situation, and I'm guessing there probably are a few scenarios out there where somebody just can't make any payments at all, you can do mandatory forbearance. And actually your servicer might kind of gear towards this, or at least maybe even push a little bit towards this. But I would say before you hit the red button on mandatory forbearance, think about what your long-term goal is, which is what the AAMC resources are really going to point you towards. If you're looking at public service loan forgiveness for a qualifying organization or state hospital, or your residency is in that category, which not all of them will be, but if your residency is in that category, then you can consolidate essentially and start the clock on your payments and start making those payments at a lower income level. And again, your income-driven repayment is going to be calculated on the income you're making now, so you're making lower payments, but you're qualifying at a lower payment level for that loan forgiveness. So you're essentially starting the clock. Not only that, you can at this point start tracking your public service loan forgiveness and get those credits applied to your account essentially. So regularly submitting your public service loan forgiveness paperwork will give you peace of mind that you're making progress towards those 120 qualifying payments. Instead of trying to maybe do it all at the end and realizing that you weren't working in a qualifying residency or not having that peace of mind. The next thing that I would say is there are some differences between revised pay-as-you-earn and pay-as-you-earn or even IBR. So we'll talk about that in the next slide. And then another thing I would say, and I was on a call last week with some medical students, and one person said something that was really kind of opportune, is one of the other strategies in student loans is your payments are based off in an income-driven repayment plan off your adjusted gross income. Well, anybody that's worked with a tax professional knows that there are many things that we can do to lower our adjusted gross income. So for instance, you can give to a retirement plan that's tax deferred. You can put money in your HSA. All of these things will lower your adjusted gross income that goes on your tax return. You pay less taxes. So these are things that really anybody can employ. But when you're paying on student loans, there's a double dip here because you're not only getting that tax break like on your tax return, but you're lowering your AGI, which means you're lowering your student loan payment when you go to recertify your income. So you can actually double dip here. You could start putting significant money away towards retirement, lowering your student loan payment, getting credit towards public service loan forgiveness. So there's you can really start to open Pandora's box in terms of getting the benefits here, which is really great. And then I would say another thing to consider as a doctor is that once you get out, like let's say public service loan forgiveness is not something that you want to go for. There are great banks out there and financial institutions that know you're going to be a good customer and want your business. And so there are great refinancing opportunities for those of you that maybe want to save on interest. And then of course you have mortgage perks as well. So if you're thinking about, hey, I'm going to be carrying $300,000 in student loan debt, $350,000, I'm never going to be able to afford a house. Think again, there are specialized programs for that type of thing. So just wanted to put that on your radar. And then again, AAMC user resources, they're really great. So one of the other things you have to think about as a doctor is revised pay-as-you-earn versus pay-as-you-earn. And so one thing that I would say is there are perks. And again, I have a massive table that goes through all the different categories, but I'm going to pull out some of the main ones here. So one thing about revised pay-as-you-earn is it has a better interest subsidy. And so it's also good primarily, and these are generalized kind of guidance categories, but they're good for longer training periods for doctors. And then there's no cap on monthly payments, which is a negative. And we'll talk about that here in a second as we talk about, I guess, scenarios here. But really, bottom line, what is this good for? It tends to be good for doctors who expect to pay their loans in full or want to refinance and like, they're not really worried about the payment cap. On the pay-as-you-earn, there's one thing in particular that makes this way better. So if you want to get married down the line, revised pay-as-you-earn makes you file jointly, and then it uses your joint income to calculate your payments. Whereas pay-as-you-earn does not do that. So that's actually one of the main benefits here is that you could, like, let's say you're a doctor and then you have a spouse that's a stay-at-home spouse. You could sorry, that would be the wrong scenario. But you can separate out your spouse's income from each other. And so you can kind of get an additional level of the ability to separate these things out where you're not being penalized from the joint filings. So that's one of the main things. The second thing, which can be very significant in terms of doctors that are going to see a massive jump in income when they get to attending, is that you can get a cap on your monthly payments. So what this means is when you enter into the pay-as-you-earn plan, when you enter in, you're essentially setting a benchmark, so to speak. And that benchmark is that whatever you would have paid when you entered the plan in the standard plan is your cap on your payment. So let's say you enter in residency and that cap is pretty low because your income is low. And then all of a sudden you're an attending physician and your income skyrockets into the roof. Well, you'll hit a roof, you'll hit a cap in pay-as-you-earn. In revised pay-as-you-earn, there is no cap on your monthly payments. And so pay-as-you-earn can kind of give you that buffer as you go out into attending and start making more money. That your payments essentially aren't going to go into the stratosphere. So that is a significant benefit to pay-as-you-earn. And so pay-as-you-earn general guidance would be, it's good for doctors who want to do public service loan forgiveness eventually. So you're starting that clock in residency, you're going on, and you're wanting to complete that 120 qualifying payments. And then there's another strategy out there, and I would say, take your time, think through it, okay? So there are some people out there that would say, okay, well, I'm just gonna slot into revised pay-as-you-earn for residency, get that subsidy, and then I'm gonna go to pay-as-you-earn as I go out. Well, there's a few things to consider here, which could be kind of massive pitfalls in that strategy. One is the payment cap piece. So if you forget that you need to go into pay-as-you-earn, which has a payment cap, and all of a sudden you're in revised pay-as-you-earn, you're in attending, and your income goes through the roof. If you're still in pay-as-you-earn, revised pay-as-you-earn, try to go into pay-as-you-earn. Guess what? That benchmark, you may not have what's called a partial financial hardship anymore, and those days may be gone. And so you shoot yourself in the foot. Then there's also the interest capitalization. So anytime you voluntarily switch to another plan, your interest is capitalized, which makes your overall loan more expensive. So there are certainly some things about that strategy that might make you think twice. It's feasible, but you can kind of step into some quicksand really quick. So just keep that in mind. I'm not saying one way or the other, but there's certainly some things to think about there. And then doctors have great loan forgiveness opportunities. So we talk about public service loan forgiveness, but it's not the only way. There are military programs. I mean, if you were open to the military, my goodness, the programs are incredible. So you can look both at, I mean, Army, Navy, Air Force, all have great programs. There's also the National Institutes of Health for those that are going into research careers that have no intention of maybe practicing as a doctor. You want to go the research route. There's the National Health Service Corps. We can look at Indian Health Services there, licensed primary care clinicians. We also have a new category, which is substance abuse clinicians. So there's categories there that you can qualify for. And then crucially, there are state-based loan assistance programs. So and the AAMC, again, pulls through for you here. They have a directory of state-based programs. So wherever you're going to end up, whether it's here in Kansas, we hope so, or elsewhere, make sure to check your state level plans, what might be available there. And there are all sorts of weird, quirky ones out there. Like, for instance, here in Kansas, if you want to go back and practice in a rural county, there's forgiveness for being in a rural county. So all sorts of opportunities there. It's not a ton of money, but for those of you that maybe are going to go back to a rural county as a nurse, and you know you're going to go there and you're headed back home, check out that program. I think it's up to $16,000 right now. All right, so let's flip the switch to nurses. Again, we may not have as many things to think about, like in terms of residency, for instance, with doctors. Now, of course, there's many levels of being a nurse, so I'm going to talk in generalities here. But one of the things I would say here too is you need to keep an eye on the forgiveness opportunities. So we again have great forgiveness opportunities for nurses in particular. We have the Nurse Corps Loan Repayment Program. We again have military programs, Army and Navy in particular. We have the National Health Service Corps again. So we have Indian Health Services, we have the Loan Repayment Assistance Program, we have substance abuse, and then we have Perkins loan cancellation, which considering who I have on the call, probably not something we need to necessarily worry about because they're no longer being issued, but could be in a broader perspective, something we need to consider if you're a nurse that's maybe been out for a while. And then we have, again, state-based loan programs. So make sure you're checking in your state in particular what opportunities are available to you. Okay, Now we have Biden loan forgiveness. So again, may not be something that you're tracking day to day. I'm not even tracking it day to day, but there is kind of rumors and whisperings out there about Biden and forgiveness. So some of you all might be asking, well, what's going on there? So first off, in a town hall in February, the Biden administration, Biden himself said that he won't forgive blanket forgiveness for 50,000. And so we know, like, whatever comes out of the administration will likely not be larger amounts of loan forgiveness in terms of like 50 grand just wiped off. And that's extremely politically risky as well. Like, it's extremely expensive. And so there's questions as to whether that's even legal. And then there's certainly the cost perspective. And so what we've seen more from the Biden administration are things like the public service loan forgiveness waiver, which is not politically risky, is fixing a broken program, and is giving, like, millions or even billions in forgiveness, it seems like. And so, I mean, it is billions. And so, like, lots of relief, but not a lot of political kickback. So that's probably what I would anticipate will continue coming out of the administration, not blanket loan forgiveness, at least not at the levels of 50,000, but certainly there's still pressure there. Actually, this is more information than you need to know, but I'm doing a research study where I pulled tweets on student loans, and there is still significant pressure on the administration to cancel student loans, at least on the social media landscape. So kind of interesting there. So other student loan issues, and then I'm going to kind of direct you to resources that can be helpful as you continue on your journey. So other student loan issues, there are programs for employer assistance. And so if you're going to work for a hospital, for instance, look at what their programs are to give assistance to people that are coming, that are medical professionals. And a lot of times there will be opportunities because you're in demand. And so many organizations are offering assistance, and there are now tax benefits to do this from the organization perspective. And so keep an eye out for that. And I have worked, like, with doctors, for instance, that within their contract, the organization they were working for was paying on their student loans. And so keep an eye out for those. There are strategies for private student debts. We really haven't talked about that in this presentation, but there are general strategies to alleviate debt concerns on the private spectrum. And so there's kind of two main strategies out there called the debt snowball and the debt avalanche. So the debt snowball is where we build momentum. So we pay off our smallest balances first. We continue to pay until we get to larger balances. Not the most efficient way, but it's motivating. The most efficient way, though, to tackle your debt is to go highest interest rate first and then move to the lowest. Again, if your highest interest rate is on the largest balance, you may not feel that momentum, but it's the most efficient way to tackle your debt. And then there's consolidation. So at the federal level, we can consolidate our loans, which there's some strategies there, like, for instance, for residency, but it can also be done to extend your kind of terms or ability to pay. It can also be to simplify things, so you don't have to pay on 20 different loans at one time. There's all sorts of different reasons, but I will say consolidation uses a weighted average and then ticks it up 1/8 of 1%. So this isn't to, like, save on interest, okay? This is for some of those other purposes, like maybe to get non-qualifying loans qualifying for public service loan forgiveness. So there are reasons to use consolidation, reasons not to use it. One other thing I would say is, when it comes to consolidation, you're issued a brand new loan, meaning that, let's say you accumulated a ton of time towards public service loan forgiveness and you consolidate those loans, you lose that time. It's a new loan. Now there are, like, under the waiver, we can consolidate and do some things, but in general terms, public service loan forgiveness, when you consolidate, you're issued a new loan, you erase that history. So before you go out and consolidate or go out and refinance, please know the implications before you do that, and be wary of some of those pitfalls. Refinancing, again, can be very lucrative if your long-term goal is to pay off the debt. So if you can decrease your interest rate, you're going to save money over time if payoff is your overarching strategy. So keep that in mind. But when you refinance losing my words here. When you refinance federal student loans into the private space, you lose those perks. They become private student loans. So keep that in mind as well. All right, so additional resources. Here are the loan servicers out there, and there is a shuffling of the deck right now. But if you need to contact your loan servicer, you can also do this from your dashboard, for instance. But here's phone numbers if you're curious. They're also posted on the best website for everything federal student loans, and that is studentaid.gov. So if you need information, of course, the AAMC or the AAMC, yes, so many acronyms, but they of course are a great resource. But for all things from the horse's mouth, this is the website. And I will tell you too that this 1-800-4-FED-AID is not just for the FAFSA, and most people don't know it exists anyway. But you can call about student loan questions here too. So this is a great free resource if you have some questions. You can also call your servicer as well. But I will tell you, and this is recorded, so I won't say much, but sometimes servicers know what they're talking about. Sometimes they don't. Just like any customer service rep ever, it depends on their training. It depends on how long they've been there. It depends, sometimes you have to talk to a supervisor type of thing. And so sometimes your servicers give bad advice. And so getting advice from a servicer, maybe from somebody who's been through what you're going through in the medical profession, maybe calling this number, getting some good input before you make some major decisions can be helpful. I would also say, again, I'm wearing my KU hat, but I do run a blog at GradMetrics, and I do post on student loan topics. So if that's of interest to you, I also have a podcast called GradCentric that you can basically find anywhere that podcast exists. And so you're welcome to follow me there. And then you have my contact information. So I am here at KU. I teach from the Edwards campus. So you can always, if you're over in my neck of the woods, you can come and see me, best 350 M. You can also call me or email me. And I have had folks that have reached out to me after I've done presentations for the medical school. And so, or health professions in general. So feel free to reach out to me. I'm happy to be a resource. And I'm going to keep it on this slide as I take questions in case you want to write that information down.
All right, well, thank you, Jason. What kind of questions do folks have out there? Feel free to either type it in the chat or take your phone or tablet off mute and you can ask it out loud.
So first question, is it recorded? Yes, they're recording it. So Scott can tell you where it'll be posted, but.
We'll put it up on the financial aid website. It may take a couple of days for us to do that, but we have a financial literacy section on there.
I have a question from a medical student perspective. We had talked a little bit about kind of if you do nothing, you default to the standard payment over 10 years. So I'm just curious, and this is a very basic question, but if we're interested in the pay as you earn or income-based repayment, what does that process look like for us? Like, what are the first steps that we need to do to make that happen?
Yeah. So first is that there's, in normal loans that you're getting, like my loans for my doctoral program, I'm given a grace period. Then you might also be given forbearance in the medical profession. But the first thing that you need to do is there's paperwork to fill out to slot into one of these plans. So if you are in a grace period and you need to consolidate to basically start the time, you may have to start there. And there's paperwork, as you might imagine, to consolidate. And a lot of these, by the way, I say paperwork, but a lot of this is an online process. But after you get to a place where you do need to select a loan repayment plan, whether that be because your grace period is expiring or you've consolidated, so you've started the clock, then you do need to fill out paperwork. And you would fill out an income-driven, essentially request paperwork. And it's the same as, again, sometimes online, sometimes via paper, and similar process to your annual income certification. So that's how you would do that. You have to request that.
If I might kind of jump in on kind of a related topic, those of you that are graduating in May, probably in another month or two, you will get an email from us encouraging you to complete what's called exit counseling. So before you borrow the loans, you got a whole bunch of information about interest rates and grace periods and things like that. But the exit counseling will focus. Now you're about ready to either start working, or maybe you're going on for another degree. What are the implications of that? And if you're going to be going into repayment, it'll ask you to select a payment plan. And that's only for the purpose of kind of walking you through what those implications are. So we do get some emails from folks saying, well, I'm not ready to pick a plan yet. And that's fine. It's kind of a pretend process, but your servicer, usually 3 or 4 months into your 6-month grace period, will start reaching out about when your repayment starts and have you select that actual repayment plan that you want.
And Liz asked for the numbers again, so I went back to that slide, but I would say go to studentaid.gov. They're updating this, and there are servicers that drop out and servicers that spin off into other entities. And so these numbers can change. And so make sure I would just check studentaid.gov and check that out. You also get regular communication from your servicer. So whoever that is, you should be able to get some of that information through some of those communications. But this was copied directly, at least a few months ago, directly off the website. But like I said, these things can change.
Keep the questions coming.
Sorry, this is another question that kind of spins off of the last one. If we are in a position where, like you said, we're graduating in May, is there anything time sensitive that we need to be doing as fourth years about to graduate, or is everything that needs to be done, all of the paperwork, that's all manageable within the grace period after graduation? Just wanting to make sure we're not missing anything.
Yeah, I mean, these things take time. They're not immediate in most cases. So for instance, like a consolidation will take a month or two. So in my experience anyway, it could be quicker, it could be slower depending on backlogs and transitions like FedLoad servicing or what have you. But they do take some time. It's not forever, but you do need to plan ahead for some of those. Now, granted, a lot of times when you're doing some of this shifting, the servicer could put you in like what's called administrative forbearance. So they're essentially kind of kicking the can down the road to give you time while they're doing these changes. So you may not be having to make like actual payments as that happens. So you may be given, I guess, an additional grace period, so to speak. But again, be careful, because when you switch repayment, there are certain things that you can do which will trigger what we call interest capitalization. And so if you have unpaid interest, that can actually be grouped back with your principal. It makes your loan more expensive over time. And so doing some of these things like being put and coming in and out of forbearance or switching repayment plans can trigger some of those consequences. So it's always good to plan ahead and make sure that you're on a timeline where you know you have plenty of time in case you run into some problems.
I don't know if it is too deep in the weeds for some folks, or if this would be helpful, but talking about subsidies during the income-driven repayment plans and that sort of thing. Would you want to talk about that, Jason, just to?
Yeah, so that's what I was talking about with, especially when as a doctor, you're really making a decision largely between pay-as-you-earn and revised pay-as-you-earn. And so revised pay-as-you-earn has essentially a better interest subsidy. And so there are some complexities here. The plans get pretty complex, as you might imagine. You can read all about it at studentaid.gov, but there certainly is a better subsidy in terms of subsidized versus unsubsidized loans in particular. And so many see a benefit, to talk practically, to using revised pay-as-you-earn during residency in particular. But again, each of these plans have drawbacks as well. And one of the main drawbacks of revised pay-as-you-earn is that requirement to file taxes jointly. So when you're looking at your income, it is going to take your joint income. So like, let's say you're a 2-doctor household, your income could be sky high. And then all of a sudden you're in a situation where the other drawback kicks in with revised pay as you earn, that there's no cap on your monthly payment. And so if you had sky high income, your payment can go sky high under revised pay as you earn. So you have to think, okay, what are my goals, my overarching goals, like with anything with financial planning? Where do I want to go? And goodness, I mean, if you think you're going to get married to somebody you're in med school with, like revised pay as you earn may not be a long-term fit for you. Okay. You may want to go with something like pay as you earn. So keep all of it kind of in a holistic view of what's going to be good for you long-term, given your long-term strategy.
And is there some nuance between, so there may be benefits on your student loan payment by filing separately versus jointly, but does that sometimes kind of shoot yourself in the foot on your taxes? Or
it does. And yeah, so that's why, which, not tax advice, but particularly there are significant advantages on the tax side from filing married filing joint. And once you do married filing separately, the tax law starts to penalize. So a lot of times if you do married filing separately, you will essentially cap out or even lose entire benefit categories within the tax law. And so, yes, you have to, especially if you're higher income, which many of you all will be, being in the health professions, you have to talk with a CPA and be like, what is that penalty? Because it could be, let's say, 15 grand or whatever. I mean, I'm just making up a number. But if it isn't going to make sense, from a tax perspective to take that, then you may do married filing joint, even getting the penalty on the student loan side. So as you might imagine, this gets complex. That's why I have a job in student loan planning, is because you can scenario all this stuff out, but certainly work with a tax professional, because you don't want to just assume that you're going to make good money from doing that strategy when maybe you're penalized more on the tax side. Yeah, great question.
What other questions do folks have?
I have a quick question. I'm interested in like foregoing the grace period so I can start that first 6 months towards the public service loan forgiveness. Is there a way? What is the way for me to go about not doing the grace period?
Yeah, so the way is to consolidate. And this goes back to the idea that, which I mean, and I don't have your full situation, but generally speaking, that's what we're talking about, is to essentially issue a new loan. And that's why I said consolidation is something you don't necessarily want to do kind of on a whim, because it is issuing a new loan, which has its benefits and drawbacks. Like it would be a significant drawback to consolidate and lose a bunch of time towards public service loan forgiveness. But if you're consolidating to get a new loan to start the clock, then that's a different scenario. So just keep that in mind. But Scott, that's my understanding how you would start the clock, correct?
That's correct. So you have to wait, Bridget, till after you graduate. You can't do that. I sometimes get people asking, can I do that in spring semester? And the answer to that is no. But once you graduate, you can talk to your servicer about consolidating and essentially giving up your 6-month grace period.
Yep.
Great, thank you.
You're welcome. One thing I'll mention to MD students on the call, we did have the AAMC out last month, and they did kind of a 90-minute presentation on kind of loan repayment plans and different things, and they have kind of specific scenarios of saying, such and such doctor making X amount, and they kind of compare, pay as you earn versus revised pay as you earn in different scenarios. So that's something you could reach out to maybe Valerie Polson. I think she put that out on Blackboard. If you have trouble tracking that down, let me know and I can get that to you. But if you're kind of a visual learner and you want to kind of look at those things side by side, that's available. And folks, are more than welcome to reach out to me, and I'm happy to kind of talk with you one-on-one about your your loan repayment questions that you might have.
Yeah, you all have a lot of great resources. Most professions don't. And so this would, the resources that you all have offered to you are kind of unique, honestly. So make sure you take advantage of those.
We do have a couple sessions coming up here shortly. We have Healthy Eating on a Budget, I believe, which is March 8th. And then March 31st, we also have a session on kind of different types of insurance from the Kansas Insurance Commissioner. So, malpractice and different things that you may encounter as a budding professional. So we would love to see you at those events if you can make it. And if folks have questions they don't want to ask the big group, feel free to stick around for a little bit. And if you're available, Jason, be happy to help. And I'm certainly happy to stay around as long as folks need as well. So
Absolutely. And you can
thank you
always
so
email
much.
me too. Yeah, you can always email me if it's something you want to do directly. I'm happy to take that call or answer that email.
Thank you.
Thanks.
How can we find this recording of the session?
Yeah, Scott had mentioned that earlier. It's going to be posted on the website for, well, I'll let you say it, Scott. You'd be better at directing.
Sure, it's on the financial aid website, and under one of our drop-down menus, it says financial aid. And let's see, where is that? Oh, it's under costs and budgets. And then there's a financial aid presentation section. So it may take us a couple days to get that out on that part of the website. But we'll have that out there for you if you weren't able to make it or you need to go over some info again.
Thank you.
You're welcome. Do you have a question, Ashlyn?
She maybe just went off and got something to eat and left the Zoom on. There she goes.